Good morning, dear students. Today we are discussing the Unit 2 Hire Purchase Agreement, Hire Purchase Account. The parties involved in hire purchase agreement are hire purchaser and hire vendor or seller. The terms related with the hire purchase agreement are hire purchaser, seller, down payment, hire charges, cash price, and hire purchase price. What is hire purchase? It is a legally binding contract or agreement. A buyer or a hirer disperses a percentage of the total cash price as down payment. The buyer settles the outstanding sum and interest in periodic installment. These transactions can also be executed with the help of a financier. The financier purchases the goods on the buyer's behalf and makes payment to the seller. The financier presents the product to the buyer and collects the amount with interest. It is a feasible buying option for no income groups. Even expensive products can be purchased conveniently. Also, industries facing cash shortages do not want to spend a huge amount at once. The parties involved in a hire purchase agreement are hire purchaser or hirer. Who is a hire purchaser? An individual or an organization purchases goods by paying installment is known as hire purchaser. Who is a seller or hire vendor? A business entity that sells goods is known as hire vendor or seller. And who is financier? A finance company gives the funds for the purchase. What is hire purchase agreement? The term hire purchase refers to a financial arrangement for buying expensive goods and services. With a hire purchase agreement, the buyer makes a down payment and pays the remaining balance plus interest in installments. The term is commonly used in the United Kingdom and it's more commonly known as an installment system. In the United States, although there are subtle difference between the hire purchase and installment system. Hire purchase is an agreement where the buyer makes a down payment and pay the balance plus interest in installments. These type of agreements are generally used for very expensive goods. Hire purchase agreements are not exactly the same as installment plans because the buyer owns the product. In installment system, the buyer owns the product immediately. In legal ownership transfers to the hire purchaser, in a hire purchase agreement only once all the payments are made. Hire purchase agreements usually are more expensive in the long run than paying full price for an item outright. How hire purchase agreement works? A hire purchase agreement is a type of credit arrangement between the buyer and the seller. After an initial payment, that is down payment, the buyer continues to make installment payments until the total purchase price and interest, including interest charges, is paid off. Once that occurs, the buyer becomes the legal owner of the product. These agreements are similar to rent-on transactions such as rent-to-own cars, which give the lessee the option to buy at any time during the agreement. Like rent-to-own, hire purchase can benefit consumers with poor credit by spreading the cost of expensive items that they would otherwise not be able to afford over an extended period of time. And what are the difference between this hire purchase agreement and installment plans? Hire purchase agreement are used in USA. They are known as installment system. Although they may seem the same, there are some distinctions between the two. With installment plans, the buyer usually gets ownership right as soon as they sign the contract with the seller. But in hire purchase agreement, the ownership of the merchandise is not officially transferred to the buyer until all the payments have been made. Advantages. What are the advantages of hire purchase system? These agreements allow companies with insufficient working capital to obtain assets that they need. They can be more tax efficient than standard loans because the payments are booked as expenses, though any savings will be offset by any tax benefits from depreciation. Business that need to retain cash but requires expensive machinery, example for construction industries, for manufacturing industries, transportation industries, might use hire purchase agreement. So might startups that have little collateral with which to establish lines of credit. So at that time, these business approach hire purchaser, hire vendor for purchasing their goods under hire purchase system. The second one, next one is hire purchase agreement can enhance a company's return on capital employed and return on assets. That's because the company does not need to use as much debt to pay for the assets. Business that need to retain cash but requires expensive machinery for construction, manufacturing, or when use hire purchase agreement. So, startups that have little collateral with which to establish lines of credit uses this facility for acquiring assets. A hire purchase agreement can enhance a company's return on capital employed and return on assets because the investment on these assets are very low. That's because the company does not need to use as much debt to pay off their assets. And some of the disadvantages are for this scheme. What are they? Hire purchase agreements usually prove to be more expensive in the long run than paying in the full cost for an asset at the outset. That's due to interest costs for a business. They can also mean more administrative complexity. In addition, hire purchase agreements may tempt individuals and companies to buy goods that are way beyond their means. They may also end up paying a very high interest rate. Hire purchase buyers can return the goods, rendering the original agreement void as long as they have made the required minimum payments up to the time of return. However, purchasers suffer a loss on returned or repossessed goods because they lose the amount they have paid towards the purchase up to that point. So, thank you for watching.